Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, 9 o'clock-ish. And when you tune into my show, you're going to hear about topics that are important to the home business community. Okay, so right now, what is on the minds of individuals is audits, right? So just to give you a timeline on how the IRS works. So during the filing season, the initial filing season, that's when the IRS opens in January, goes through to April 15th. That's the filing season, okay? And when the IRS processes returns, they process refunds first, and then they process tax liabilities. And then we get to the part about the audit. So generally during the summer months is when people start receiving letters from the IRS. But we're specifically focusing on audits. So what exactly is an audit? An audit is when the IRS reviews your tax return to make sure that the information is reported correctly and according to the tax law, and to verify the amount of tax reported. So the way that our tax system is described is that we have a voluntary reporting tax system, which means it doesn't mean that you have to volunteer to file taxes. Filing taxes is required. When you have that filing requirement, that's a whole nother broadcast. But the IRS allows you to submit your income and expenses for your business, the income that you earn throughout the year, your tax deductions and all that. You say, okay, here's how much I made. Here are my deductions. Therefore, this is how much I owe. That's what that means when we're talking about a voluntary reporting system. You say, this is what I'm reporting and all that, and this is what I owe. So so when the audit happens, that's when the IRS says, okay, hey, let's check this return. Now, a lot of times people want to ask me, and especially when dealing with tax deductions and such, I always get the question of what are the chances of me getting audited? And my response is always to prepare your return as if you knew you were getting audited tomorrow. There is no crystal ball. There is nothing that one can say that, yes, you're definitely going to get audited. No, you're definitely not going to get audited, because that's not our decision to make. That's the IRS's decision to make. So no, there's no one that can tell you definitely you'll get audited or you definitely won't get audited. I personally don't like to be trying to play audit roulette anyway, because when you win that game, it's not cute. All right. Now, there are different types of audits, and then once we get that, we'll get into those audit triggers. So that there's different types of audit, but the three most common types of audits are the correspondence audits. This is when you get a letter in the mail asking about more information on X deduction, okay? Then there is the office audit that is a little bit more intense than the correspondence. The office audit is when the IRS says, hey, we'd like for you to come into our local audit. So that's going to be a little bit more in depth than the correspondence audit. But then there is the field audit. That's the one that you see on the movies where the IRS show up at your business and your house and they looking at everything. That's the most comprehensive type of audit. And that ain't what you want in your life, okay? If the IRS shows up at your house to audit you and all that stuff, or your place of business, then you know something has gone completely left, all right? But now, but then again, we get to the question of, what are these audit triggers? What are the things that might trigger an audit? And there are lots of things. It's a big picture thing, but these are some things that really stick out that the IRS catches, and then they say, hey, we want to know more information. So number one is consistent business losses, okay? One of the things that the IRS looks at is if you're in profit, whether or not you're in profit 3 out of 5 years. So if you're consistently claiming losses, by that 4th year, the IRS is probably going to send you a letter in the mail saying, hey, we'd like more information about XYZ. It doesn't mean, and an audit doesn't necessarily mean that you've done anything wrong. It's just something, caught the IRS, this is more computerized now. Something caught their eye and they say, hey, we'd like to look more into this, okay? So that excessive business losses on, when you're a sole proprietor or a single member LLC and all they see is loss after loss after loss. And when we're talking about those losses, and they're not getting smaller, so you might have a $10,000 loss one year, then you're having a $12,000 loss the next year, and then you have a $14,000 loss the year after that, the IRS goes, how are you still in business, right? And even on the reverse side, even if your losses are getting smaller, the IRS is still looking at that and just, basically building a picture is what they're doing, okay? So excessive business losses and continuous business losses, that can trigger an audit, okay? Number 2, round numbers in your deductions. Now, one of the things that kills me is when I've had someone come to me with a list of deductions, cell phone, $1,000, gas, electric, $2,000. All of these numbers are just end in 00000. That does not make sense, because 9 times out of 10, if you look at your bills, it's not a round number. You might have $46.13, or you might have $152.49, but never is it really $100, $40, that kind of thing. So when all of your deductions are just straight zeros, like in the thousands of dollars, then the IRS goes, how is that even possible? That the likelihood of all of your expenses rounding off perfectly to the nearest $10, that really isn't likely. So that's something else that's going to trigger an audit, because the IRS is saying these are just estimates and guesstimates. This is not actual stuff. So then they're going to go back and say, okay, we'd like to see the documentation on this. Okay. Now, if your documentation says that, hey, this is what it is, okay, great. But if it's not, then you might be in trouble. Okay. Number 3, excessive mileage. Now, when IRS auditors are trained, they are really trained on the Schedule C, because there is so many evidences of fraud, okay, instances of fraud. I mean, you see it all the time. You see tax professionals getting hemmed up and getting prosecuted all the time for filing false Schedule C businesses. And one of the first places they look is the mileage. Now, you might ask, well, what would be considered excessive mileage? Well, it depends on the big picture. It depends on the business that you're in. It depends on how much money you've made, how much money you've lost. And they also look industry-wide. Like, does this even jive with what's going on in the industry with other people that are in the same line of work? Does this mileage actually add up? And if it doesn't, then guess what? They're going to be asking for more information. And you have to understand that mileage is the highest paying tax deduction for the Schedule C. I think mileage for 2019 is 58 cents a mile. Don't quote me, but I think that's it. So you think about that 58 cents a mile that you get to deduct on your taxes for driving for your business. Now, one of the reasons that you have excessive mileage is because you have been given false and erroneous information. So let me tell you now, slapping a sticker or a magnet, I don't care if you shrink wrap your vehicle in your business, that does not make your mileage, all of your mileage, tax deductible. That is an advertising cost, but that doesn't mean all of your mileage is tax deductible. What makes your mileage tax deductible is if it's a specific business purpose. If you are going to meet a client, if you are dropping off product, if you have to go get supplies for your business. So yeah, you have to make sure that you are only claiming mileage that has a specific business purpose. Now, if you just driving around town so people can see your business, that is not considered a business purpose, okay? Let me just let you know. So excessive mileage is definitely something that will show up. All right, number 4, excessive deductions in relation to your business activity, all right? And that can be anything. We just talked about mileage. It can be meals. It can be travel. So the IRS is basically saying, okay, with the amount of money that you have made and looking at the overall percentage of your deductions, does this make sense? Right? So you have to look at, the value of the product that you're selling, what your overall return is, what your overall revenue is, and does this make sense? So if you have, $15,000 worth of meals, so the IRS goes, $15,000 worth of meals. Well, if you made $800,000 that year, $15,000 worth of meals might not be considered excessive. But at the same time, if you only made $20,000 that year and then you have $15,000 worth of meals, that might cause somebody to stop and think. Okay, so you have to really look at the overall big picture. Now, just to say that, having X amount of meals is going to trigger an audit, that is not what I'm saying. It's an overall, in overall relation to what it is that you're reporting, your income and your other expenses and all that. Okay. So just excessive deductions. And then last is underreporting income. I saved this one for last because this causes more headache than anything. One of the things that people really don't realize in the home business industry is exactly what the reporting requirements are for different types of industries. So you have the 1099 miscellaneous, you have the 1099K. Those are the two major 1099 forms that you will see in the home business industry. But there are others. You've got the 1099 INT, which is your interest, 1099 DIV, which is dividends. So, but if you get a tax form in the mail, whether it's a 1099 form, a 1099-R, if you have, W-2 wages, if you went off and got your life gambling, you get the W-2G, then if you get that form, there is a copy waiting at the IRS, and the IRS has what they call an automated underreporting system. So it's essentially computer matching. So the company files their forms, and then they're waiting for you to file that same form to match it up, and they say, okay, that's done. So when that form is still hanging out at the IRS and you have perhaps filed your taxes and didn't report it, or you haven't even filed your taxes at all, the IRS is sitting there waiting for you. And after a while, you'll get a letter from the IRS saying, hey, you owe us X amount of money because you didn't report the income. So just understand that, the different entities that you deal with, whether on the e-commerce side, if you're selling your own product, if you're using third-party pay like Amazon, Stripe, PayPal, all of them have various reporting requirements, okay? And so when they report to the IRS is just waiting on you. And then when you don't report, then that's when you start getting letters saying, hey, you didn't report this to us, so you owe us money. So just know that all income is reportable, whether someone else reports it or not. It is still your job to report your income. Okay, even if you're below the threshold for any of the 1099 forms, you're still required to report your income. And in the process of being audited, know that, the IRS can look at your bank statements, can look at your credit report to see, okay, if this person is not reporting any income, but yet we see all this money coming in and going out, there's something that's not right. That absolutely can trigger an audit for you because they're looking to see where this money came from. And then if you're, and so that's how something that is civil, like an audit, can turn into a criminal investigation because they're saying, okay, if you're not paying any taxes, then perhaps you're committing tax evasion. And then they go look for that. So even though, the things that I named, these are not the only things that trigger an audit. In a combination of things, it absolutely can. So I encourage you, as I always do, is to treat every tax return like you're going to get audited tomorrow. Make sure you have your documentation in place. That is what will save you in an audit, is your documentation, not what you thought and all that stuff. Having documentation for what you're claiming is the only thing that's going to save you from an audit. I can't tell you how to prevent an audit because there's nothing I can do to do that, nothing anyone can do to do that. You just have to be prepared in case you are audited to defend whatever your deductions are. All right. So thank you guys so much for tuning into Home Biz Tax Talk. Again, we air Monday through Friday, 9 o'clock-ish, and you can come right here to get your questions answered about your home business taxes. All right. Have a great day, and I'll see y'all next time. Bye.